Good afternoon, everyone. I'm John Klobasicki, Director of Wealth Management at Fairport's Harrisburg office. We are welcoming our clients across all of our offices today, which includes not only Cleveland, and shout out to Cleveland on an exciting night at Progressive Field last night, but also Buffalo Grove outside of Chicago, here in Harrisburg, Pennsylvania, Buffalo, New York, Cherry Hill, New Jersey, and Princeton in New Jersey as well. As always, it is our pleasure to serve and work with your families. And based on past feedback, these webinars have been scheduled on a quarterly basis. And you'll see leaders from all of the Fairport offices taking turns moderating. The goal of these town halls are to connect you directly with John Silvis, our Chief Investment Officer. He will recap where we've been, his thoughts on where we are today, and what the year ahead might bring. We've asked for your questions in advance, and John and his team have prepared slides addressing those and other frequently asked questions. Please also be assured that your advisors are in continuous contact with the investment team. And here are some ways that you can be too. You should be receiving Fairport perspectives via email. If you're interested in weekly updates, ask your advisors to share our weekly Fairport market note. We do send that out in Harrisburg on a weekly basis. You can subscribe to Fairport Flash, a monthly podcast available on Apple Podcasts and Spotify. Finally, you can follow the hashtag #InvestingWithFairport on LinkedIn and Facebook for frequent thoughts on the markets and the economy. As always, you're muted on this webinar, and we are unable to see your faces. If you have questions during the webinar, you can type them in the chat window, and we'll answer as many as we can, time permitting. With that, I'm going to turn it over to John, our Chief Investment Officer. John?
Hey, thanks, John. I appreciate it. Yeah, I guess I should have worn Guardians colors. I didn't think about it this morning, but exciting game last night, and they play again tonight. We were just talking about it's quite a night here in Cleveland. They have both the Rock and Roll Hall of Fame inductions and playoff baseball, so it's going to be exciting. But as we get started, we talk about the Magnificent Seven a lot as it relates to stocks, and that's been kind of one of the headlines all year long. Well, there's a new Mag 7 for at least the next, what we got, 18 days, I think, John. So for the next 18 days, and it's the Magnificent Seven swing states. So we'll talk a little bit about the election. I didn't color code these, but the top ones are what they call the Rust Belt states. The bottom ones are the Sun Belt states. If you've been in any of those 7 states, and I know, John, you're right in the middle of it, you're going to be hearing ads for the next, I don't know how many days, but good luck to everybody, and I think we'll survive it over the next 20 days. So to kind of jump right into it, it's been a great year so far in the equity markets. We've had very little volatility, which we'll talk about in a second. Equity markets continue to climb higher as we head into the fourth quarter, which historically has been pretty good, and as we get into year end, as you can see on that far right column there, the large caps again are leading, much like they did last year. They're up about 19%. That's the S&P 500. If you look at it just through yesterday, which is really only a few more trading days, it's up almost 23%, or actually a little over 23%. The ACWI, which we use as a benchmark for our global accounts, which is a global equity index, it was also up about 19% for through the third quarter. But again, up a little bit more than that, not quite as much, about 19.5% so far year to date. And small caps, as you can see at 8.7%, they're that orange box, have been picking up a little bit here. We'll talk about that as we go through, but our hope is, our belief is, we'll see a rally in small caps as we get into the end of the year. What's really been driving all that? Well, it's been the Fed. The Fed finally started cutting interest rates, which we've been waiting for pretty much all year. I know earlier in the year the thought was they would do it in March. That kind of got pushed back. Now they did the first cut here in September. Inflation is finally coming down. I would argue inflation's been, it's kind of a 2024 story, and I think we're going to put that behind us here fairly soon. And then obviously we have the election coming up, which, could add some volatility, but so far we really haven't seen that. It has very little effect. But as you can see here, um, again all the way to the right there, year to date, our biggest drawdown has been 8%. Historically speaking, that's pretty light. Usually get at least a 10% correction every year, and 3 or 4, 5% correction. So not sure how it's going to set up, but if you go, and it's hard to look at these columns, but if you go back to 2017, which was the first year of the presidential cycle, so the year after election, we only had a 3% drawdown. And then if you look at 21, we only had a 5% drawdown. So, we could see a post-election year in 2025, which would continue the low volatility going forward. But we have to get through the election first, and then we'll worry about that second. But again, we've seen, I think, 40 or 42 all-time highs. Our most recent one was on Wednesday. We had another one. History will tell you, when the Fed starts to cut rates near the all-time high or within 2%, I actually think we hit a high the day they cut. Markets tend to behave pretty well, and bull markets, if you're already in a bull market, it tends to like that. In fact, you can see in that lower right corner, there's a blue circle there. It's happened 20 times, and all 20 times a year later, we've seen the markets higher by about a little less than 10%. So again, not guaranteeing a 10% return, but it does kind of put a tailwind behind you versus a headwind, and history would tell you cutting rates near highs has been good for markets. So hopefully that pattern will continue. Again, as you look at the historical pattern, and we're in that election year, what they've called the fourth year of a presidential cycle, it tends to be pretty positive. Now, this is a composite of not only the 4-year presidential cycle, but the decennial cycle as well. But it's really more the direction, not so much the returns. And as you can see, it doesn't follow it step by step, but from a trend wise, we're following it fairly closely here. And as you can see, that November, December period and into the end of the year, you tend to get a bump. Either it's called post-election bump, but more likely it's just a fourth quarter, and fourth quarters tend to be positive. So, it's our thoughts, we're going to see probably more highs as we get into the post-election. I guess, what do we have, about 45 days, 50 days after the election. So, we expect to see a little bump. Some of that might be happening now. Sometimes that gets pulled forward a little bit. Before we jump into the economy, John, I don't know if there's any questions out there, or if you have any thoughts before we move on.
No questions out there, but I wanted to throw one out, John, and that when you're talking about the election, is there an election scenario that, in your opinion, would result in a market sell-off or a big market runoff? Is there a scenario where that might happen?
So I'll talk a little bit more about it. I have some slides at the end, kind of what we're looking for going ahead, although ahead in this case is only a couple weeks down the road. But I've said this before, and I'll stick with it, that longer term, I don't think who's in the White House or elections have a big impact on markets. Obviously, sometimes when there's corporate taxes or things like that in play, you can have some volatility. But I think, John, less over who wins it. If we get to a point where we're in a deadlock and it takes us 2 or 3 weeks to figure out who the president's going to be, and there's lawsuits being filed and all that, I think that would be, kind of a repeat of the year 2000, where it took us, I don't know how many weeks, actually how many months it took us to figure it out, and then the Supreme Court had to step in. So that would be, to me, the biggest concern. I don't think that's going to happen. But yeah, that would, less on who wins and just the uncertainty of it. I know, you and I have talked about the wall of worry before, and that would be one whopper of a wall to worry about. So that would be my biggest concern.
Okay, we just got a question in. Do rate cuts actually help earnings?
Well, at the end of the day, the Fed cuts the Fed funds rates, which is short-term rates. That affects money markets and treasuries, short-term treasuries, commercial paper, things like that. It also has some effect on mortgages and commercial loans and those things, but that tends to be a little less correlated. But history would tell you as the Fed cuts rates and rates fall, and they usually fall across the board, not all at the same exact rate, but it will fall. It tends to be a lower cost of capital, right? So if you're going out to finance a house or a mortgage or anything like that, you tend to see lower rates, and lower rates and lower funding tend to be better for margins. So I think it does have an effect. I think it's a trickle down effect. It doesn't happen overnight. Rates go down and
Mhm.
you see earnings.
Okay, yeah,
Yeah.
the full question was, do rate cuts actually help earnings or just raise equity prices or both? So
I would probably say both. Yeah.
right.
I mean, eh, my belief is, and I've said this numerous times over the 20 years, is, if the economy is doing well, and so far I think it is in this case, but if the economy does well, that tends to do well for earnings. And if earnings are rising, that tends to be a good indicator for the direction of the equity markets. So I think they all kind of play together. Lower rates, lower cost of capital, lower funding tends to be a good thing, and I think that trickles through. So,
Okay.
so as far as the economy goes, I mean, I already kind of tipped my hat here a little bit, but my hand. Uh, there's really no signs of recession out there. I know 2 years ago in 2022, almost 100% of the people were convinced that we would see a recession. In 23, that never happened. So we're at the end of the third quarter. We're just started the fourth quarter, so we're going to see a GDP number for the third quarter probably sometime next week or early. It'll be before the end of the month. And right now, the Atlanta Fed, which runs their econometric model, and I show this all the time because I think it's a great indicator, is forecasting about 3.4%. My guess is that the third quarter is going to come in somewhere above 2.5%. I don't know if we'll get to 3.4, but that's on the back of the second quarter, which was also very strong. So I think the economy looks like it's on pretty firm ground. Other things that we look at again is the Evercore ISI survey, and we've been talking about this line in the sand at 45 for a while. It's kind of danced with it a little bit here. We've been down to 47, 46 and a half, but we haven't got to 45. If that would happen, that'd be one of the indicators, and I think we would have to reevaluate how we see the economy right now. But so far, it's held above that 45. So again, not a sign of a recession there either. And then finally, the job openings, kind of a return to normalcy here. We're seeing going back to pre-pandemic levels, which are somewhere below that million number. And I will tell you, anecdotally for me, I can't speak for all of our offices, but I don't walk into restaurants as much as I used to and see the help wanted sign in the door and the please be patient with us, we're understaffed. You used to see that all the time, and you don't see that as much. So I think that's another sign that we're kind of getting back to that pre-pandemic normalcy. I think there's still some job shortages out there, but not nearly. The jolts is job openings versus layoffs, and as you can see that number. I remember we would talk about there was 2 jobs for every person looking, and that ratio has definitely come down. And then the other thing is that we're looking at from an economic standpoint is the consumer net worth for our customers. It's year over year about 9%, and as you can see there, it says that consumer net worth leads real GDP by about a half a year. So that tells me between now and call it end of the first quarter of 25, we should still see some pretty good movement and a positive growth in the economy. Again, what makes up consumer net worth is 401 for most people is retirement money, your investments, and your house. And so far, um, as we've mentioned already, equity markets have been pretty consistent this year. So people are seeing higher um, balances on their 401ks and their investment portfolios. And for the most part, housing prices have held up pretty well, and in fact, still have been increasing. So things, things look pretty positive there as well. So nothing on the horizon right now for us that points to inflation. I'm sorry, of a recession coming on anytime in the near future, and any more than 2 or 3 quarters down the road always gets a little hard to forecast. So um, so shifting a little bit away from the economy, but just on other economics, inflation continues to trend lower. I said earlier that I think it's kind of been a 2024 story, and I think that's about behind us, if not pretty close. As you can see here on that blue line to the lower right, that's the CPI number, and that's down to 2.4%. It doesn't drop like the line I drew, which is a straight line. You're going to get a little choppiness there. But I still think we're going to continue to see that trend lower. Our thought was we would get CPI under 3% by the end of the year, which we're obviously there. I would not be surprised if we're at that 2% target of the Fed sometime in 2025. And then, if you again get one of these perfect storm scenarios where you have Fed cuts, but no recession. And again, I think we laid out why we think there's no recession, and the Fed has already cut rates in September. It tends to lead to higher markets. And this is a chart by Ned Davis. There's two colors there. The red is when they cut and there's no recession, and there's been a few of those. And then when they cut and there has been a recession, or they cut after a recession. History would tell you markets tend to react much better if there's no recession during a Fed easing cycle. And so far, that seems to be the case. So again, that's a good setup going forward for equity markets. And then just, the last thing as far as the economy, and I know you talked a little about interest rates earlier, John. Credit spreads are historically low, or at cyclical lows here. That tends to be a good sign. And why is that? If you start to see credit spreads increase, that's usually because the economy is slowing and or defaults are going up, and the risk of losing capital goes up, so you have to raise your interest rates. So far we haven't seen that either. So again, I think we're it's kind of a Goldilocks spot with the economy, where we're seeing pretty good growth, falling inflation, and we have a Fed backdrop of easier monetary policy. I don't know how fast they'll move on that. It could be slower, and that's another whole other concern that most people think they'll cut twice this year. I mean, 2 more times this year, but we have one right after the election, and that'll be interesting. So I saw a couple questions that look like they popped up.
There are a couple of questions. One, is there still, going back to your slide on the jobs number and labor, is there still a labor imbalance creating inflated wages? And would this be a major contribution to inflation going forward?
Yeah, so I guess what I was trying to do, and maybe didn't do a great job at it, was trying to say that the equilibrium is kind of getting back to where we were pre-pandemic. So yeah, 2 years ago, a year ago, year and a half ago, we definitely saw the help wanted signs and the job openings, and it was definitely an employee market where you could ask for raises. And my kids went through that process with their jobs and asked for more money, and employers were kind of behind the 8 ball. I think that shifted. The wage inflation hasn't really been an issue for the last 12 months. I don't know if that's going to change. My guess is it won't. Unemployment's ticked up a little bit here, but we're still up well under 5%. I think it's 4.1 if I'm not mistaken. So I think that I think we're moving back to that equilibrium. So I don't think wage inflation or wage growth is going to be a big factor on inflation going forward.
Okay. One more before you leave the economy section. One more question from the field. How will higher taxes affect growth predictions, expected growth as we look ahead?
Well, so higher taxes, I'm not sure we're gonna have higher taxes yet. We'll have to see how that plays out. I think if that's the case, could have an effect on growth. I think it would. How much? Honestly, I don't know. Depends really where the rates end up and who gets taxed. If they raise corporate taxes, which I think Vice President Harris has indicated she would, I think that's going to have some impact. How much is kind of hard to say because no one really knows what the rates is and where they're going to be. On the flip side, I think if President Trump gets his way and he wins election, and I think he's probably inclined to hold those taxes where they were from 2017, and we'll get into that a little bit on the back end. But I think his thing is, he has threatened to raise tariffs, which at some point would be a tax as well, either on cost or goods. So kind of pick your poison on that one. But I think both would have some effect on growth going forward. But what's the old saying about making legislation? It's like making sausage. It's not a pretty process. So we'll see how it ends up when we get there. So any other questions out there, John? If not, I'm gonna just keep going.
I'll let you go. I have one more, but let's go talk about the market. This is more market related, and we can circle back.
Okay. All right. Sounds great. So, kind of tipped my hand on this one as well, but new highs tend to lead to higher highs, and we've seen 46 so far this year. In fact, that's I think now a scratch. That's 47 because we saw one earlier this week, and I don't know where we're going to finish today, but we were close already this morning. So, it's been pretty remarkable. Back in I think it's 22. We saw 70, so we're not anywhere near records, and I don't think we'll get to that point going into the end of the year. But there was a survey done. When's the best time to buy stocks? And you would think at all-time highs is not the answer, but history would point out it's one of the better times to buy those. So again, I'm just looking for directional things, and I think this is another one of those tailwinds that we're going to face going into 2025. So valuations remain elevated, and that's been a question we get a lot. Rates are starting to come down. Hopefully that'll have some effect. But there's a study by Goldman Sachs, and they looked at when we saw the ratio get above 20 times, and history would tell you. And we saw that back in late 23 this year or this cycle. And when you get above 20 times earnings, and we're at 21, as you can see, 21.5, it lasts about 2 years. So you don't tend to rise up above 20 and then drop right back down. You tend to hold that area. On average, you hold about 2 years above 20 times earnings. And during that time, you get about a 52% return. So it tends to be during a bull market and probably during that second half of a bull market. And we're only up about maybe 25 or 30% from that point, so we have more to go. If we rise the average, we could do better than the average. And over those 2 years, it's on average like a 26% annualized. So I think it's an area of concern. We obviously have seen returns over the last year and a half be pretty good, even though we've seen high market ratios or multiples, but it doesn't always signal that the market's going to correct at that point. It will at some point, but history would tell you have about a 2 or 3 year period where you stay elevated in that area, and returns tend to be pretty good. So I don't know if you had a question on that directly or
actually, yeah, it's a good time. This question was brought in earlier, but I think it relates directly to this slide you're talking about. Is private equity affected by rate cuts? I mean, we all know the response in in the public markets is, it's immediate, the information is disseminated. But
Mhm.
what about private equity? I mean, is it really affected by rate cuts and, or is it really a
Well,
long-term thing?
private equity is part of the economy like everything else is, and lower rates tend to again be a better lubricant for the economy going forward. So I would think it has a positive effect on private equity. It probably depends on what stage you're looking at, if it's late stage or early stage of private equity. But that being said, yeah, I definitely think it has an effect, probably a positive effect. But how fast, to your point about the more immediacy in the public markets, because the markets will react, as the Fed's announcing. So you probably don't see that in a price or NAV, but I think it does have a positive effect down the road. So um, I'm a believer lower rates tend to be good for everybody. So
Okay.
yeah. So we talked about the Mag 7 for a second earlier, but really, if you the top 10 as a percentage of the S&P has been coming down. That's early. I'm not going to uh, ring the bell at this point, but we have seen it come down over the last couple of quarters, and we definitely have seen a broadening out of the market. It's not just been led by those 7 names that have driven the market over the previous 18 months. In fact, if you look at this chart, this is from Bloomberg. That blue line is basically the S&P 500. They call it the Bloomberg 500 minus the Mag 7, which are Microsoft, Apple, Google, Nvidia. I probably missed a few, but the main culprits that we've been talking about. And the markets have still gone up. So we've seen new all-time highs, even with that 493 index. And then that white line is basically took the S&P 500 and just equal weighted them, versus having a huge overweight to Apple and Nvidia and Microsoft. You just took them all and you equal weighted them. It's also at a new high. So we're starting to see that broaden out. It's not just been driven, especially the last quarter or two, by 6 or 7 stocks. I still think those stocks have further room to run, and they probably will see higher prices as we get into the year end. I don't know if they'll be, the only market leaders to do that. So that's something we're keeping an eye on. I think from a health standpoint of the market, the broader it is, the better. So that's definitely a good sign. Again, within the markets, we're entering that sweet period of seasonality where November, December, January tends to be the best 3 months of the market. I don't know. I have no reason to believe it wouldn't be this year, but again, in this case, it is an election year, so that first few days, and I think the election's on November 4th, if I'm not mistaken. Although people are already voting, so I don't know if that changes it or not. But history would tell you that November, December, January tend to be a pretty good period. Fourth quarter tends to be a pretty good period. So we're entering that period of better than average returns, and hopefully we'll see that historical pattern continue this year as well. And then, as I mentioned, we're entering the best season, November through January, but we've had 5 months in a row where the markets have gone up. We have a 5-month win streak. So to say it better, you go back to 1950. Usually, when you get that much momentum in the market, meaning 5 months in a row, that's happened 20 times, I believe, if I counted it right. Maybe I didn't count that right, but anyway, I'm sorry, 29 times. 28 of the 29 times you can see in that green circle, the markets were higher a year later. So you look at the average or the median, somewhere around 10%, let's call it. So another reason why we're in a bull market. We just finished the second year. They tend to go on longer than that. I'll show you a slide on that in a minute. And I would think we're more in the middle of the cycle than in the end. So another reason why we think markets can move further. As far as rates go, and we've been talking about bonds, and we had very high short-term rates, 3-month, 6-month treasuries, and you would get over 5%. We're starting to see the Fed cut rates. As I mentioned, they made their first cut back in September. They cut 50 basis points. So you can see that red line there that shows the Fed funds rate. They held it steady there for quite a while, but we've seen its first drop at 50 basis points. History tell you the Fed fund tends to follow 2-year treasury yield, and we started seeing that come down sometime back in March or April of this year. So the Fed kind of got a little behind the curve. You could argue that policy was a little tight, and they're starting to make that change. So the Fed fund rate's at 5, the 2-year treasury yield is somewhere around 4, call it, maybe a little under 4. So, most likely to replicate or to rectify that, my guess is you'll see Fed funds rate come down, not the 2-year yields come up as much. So I think we'll see further cuts. I don't know how many times this year. My guess is they will cut the 2 times at 25 basis points apiece, but we're going to be moving at least down to that 4% range. I think is probably the first phase. Very well could get actually lower than that before they're done with their easing cycle. So that's kind of where the markets are. Again, happy to take any questions if you have them out there, John. We can just keep moving.
Yeah. One quick question, and it goes to the bull market comments and to the market highs. Valuation, we know, tells us really nothing about the timing of the next move, up or down, but it can tell us a lot about the magnitude of the next move, up or down. What is valuation telling us now in regards to the next move, whether it is up or down?
Well, so like going back to that Goldman Sachs study, they tend to believe, valuation can stay high. They historically have stayed high around 2 years, at least for 2 years above that. When you get above 20 times and you see returns of, I think it was 56%. So, we're probably halfway through that. So, my best guess is, although we see high valuations or high multiples on the market, and do I think they'll stay there forever? No, I think they'll probably start to come down. But that being said, I think we can see a period of high multiples and high returns, or better than average returns, for at least the next year or two as we move forward. But yeah, I mean, I think multiples do matter over the long term, and we're in a period of lowering rates, so that tends to be a little bit of a positive relative to valuations. But I don't know if it's 18 or 19 or 20 times where we kind of settle in, but probably lower than where we're at today.
Okay, thank you.
Yeah. So within our portfolios, within the large cap equities or the S&P sectors, we've maintained overweight technology for quite a while. Again, the benchmark returns for the the benchmark weightings for technology is about 34% in our portfolio. It's 31%, as you can see there, for the benchmark, which is the S&P. So we don't have a large overweight, but on that right column, we're about 2.5%. That's fluctuated anywhere from 2 to 3% over the last, call it, year or so. But definitely like the cyclical areas versus defensive. Now, to be fair, utilities have done pretty well this year, and we have been underweight those. Staples have lagged, as have energy to a certain extent. Real estate started to pick up, so it's something we're looking at. I don't know if we're through the commercial real estate bottom on pricing yet. It seems like if we're not there, we're pretty close. But areas that we're looking to add to would be in the healthcare area, and we have added to financials, and probably will continue to look at that going forward. Again, cyclicals continue to be leadership. One of the easiest ways to look at that is to look at consumer discretionary names, which are hotels, travel, some of the retail stores, things like that, versus staples, which is your Procter and Gamble's and Clorox's and companies that when you get the rubber hits the road are the things you need to basically get through the rough period. So if you look at that, it's starting to break out again. And I know this is a busy looking chart, but if you look at those two blue lines on the upper right, it kind of shows you a channel it's been in, but we're starting to see that break out, meaning discretionary names are doing better than staple names. And that tends to be, one, a good sign for the economy because there is extra spending. And two, it tends to tell you that the overall market leadership is continuing to lead towards a cyclical. So that's one of the things we look at quite a bit. And I think it's reinforcing what our thoughts were as well. Small caps. So to kind of go back to the Fed cutting rates, they tend to do very well when the Fed starts to cut rates. We literally just started in September. We're starting to see them start to break out here. We've had a couple false starts, so I won't ring the bell and say it's a guarantee or anything like that. But small caps are on the verge of breaking out. I think we're going to see that continue into year end. They tend to be very good fourth quarter performers as well. So I think, as we get into 2025, I think small caps are going to be one of the opportunities for people. And then just on the bond side, we don't talk too much about our bond portfolio, but for the last year or two, maybe a little longer than the last 2 years, with rates as high as they were, we were cash, or what we would call cash equivalents, meaning like a 3-month treasury or less, or even money markets, were yielding 5.5%. And, there wasn't really a reason to go out on the curve, so to speak, or try to go out for a 2, 5, or 10-year bond because of differentiation in returns or yields. But as we get, again, we're in a new environment now where we're in a easing cycle, which wasn't the case for several years prior to that. And as the Fed cut rates in September, and we've started down that easing cycle, which will probably last at least a year, if not longer, as you can see in this chart, and just really look at over to the left, over a 1-year period, that light blue or bonds tend to outperform cash. So as we were keeping things in cash or in short-term positions, it's probably an opportunity to start thinking about lengthening out that duration a little bit. And for the advisors out there that want to have that conversation with their clients, my colleague Rick D'Amico would be happy to have that with you. He was helping a lot of people, look for shorter term, either paper or money markets to kind of capture that 5% with very low risk. But I think it's time you want to start moving out a little bit on that curve. So, and again, if you look over the 3 and 5 year numbers, it holds the same, where bonds tend to do well. So that's a little bit of a change than what we saw over the last couple of years. And I know, John, you guys have were pretty active on money markets and some of the treasury bills because of the yields. But we've already seen them cut once. My guess is they're going to cut at least once more this year and probably a few times next year. So we're going to see some changes going forward. Mm-hmm. So, but kind of before we get into the year end, any other questions out there?
John, just one question on the utilities. You currently have no allocation to utilities. Last month we saw Microsoft reach out to Constellation Energy, and they are in the progress of talking about putting back online 3 Mile Island's #2 reactor, and Microsoft buying all of the power, which sounds bizarre, but that is actually happening for their AI initiatives. This week, we heard Google and Amazon coming out with the same thing. So, would utilities selectively be an option here? Or is this, kind of a movie we've seen before with too much hype around it? Or is it somewhere in the middle? It just sounds crazy, but that is what is
I think there's a demand for energy out there, John, right? And there's a fear, and I think it's probably going to come to fruition that as we move out, and I do think this AI, I don't want to call it a theme, but moving towards AI and more AI applications, I do think it's real. I think it's going to happen. How fast, I don't know, but but the grid as it stands today, the electrical grid probably can't produce enough. So to your point, I know a lot of these tech companies are looking out into the future and say, how do we solve this? And I think they've determined that wind and solar is not going to be the answer, and they're revisiting nuclear. I will tell you, John. So I grew up in Pennsylvania, Western PA, but I had a uncle lived in Carlisle during that. I think I was 6 or 7 years old when they had the issue with 3 Mile. I remember them leaving because they had a little child, and no one really knew, and they came to Western PA to stay with us. So I remember when they shut it down, or when they had the issue and shut it down. But I do think that is an option out there. So as that relates to the utilities, historically speaking, we haven't really owned a lot of utilities because they tend to be, you know, more of a conservative holding. They have a yield to them. They're highly regulated. They're only about 3% of the index, so it wasn't something that was a high risk if you didn't have any. I guess, to be honest with you, I'm maybe rethinking that a little bit. I do think that they're going to play a role somewhere in this expansion of artificial intelligence and the grid, and how we generate the electricity to get there. Um, I think that's kind of probably a secondary or a tertiary phase down the road. So I don't know. I'm probably more comfortable in the Nvidias and the chip makers at this point, but it's highly likely that they're going to play a role down the road. So something we've looked at. I don't know if I'm ready to jump, head first, maybe dip a toe in at some point, but I do think they're getting a second look by a lot of people because, to your point, and I think like Amazon was the one in Virginia, and they were looking to team up with, I think Dominion, right? Because I think that's where they're head. So they are out looking for opportunities, and they're going to basically fund the building of these small nuclear facilities with the expectation they're going to get 90% or whatever of the energy. So it'd be interesting how it plays out. It's definitely something to keep an eye on.
Thank you.
Yeah. So let's move forward, and then we'll take whatever's left at the end. So talk about the economy quite a bit at the beginning. I think you don't hear the word soft landing much anymore, or recession. Those things have kind of faded. I think we're in that, as I mentioned before, and I'll come back to it. We're in that Fed cut with no hard landing, or basically no landing, just a normal economic cycle. So again, 3 months and 6 months down the road, that tends to be pretty good. I already talked to you about when we're near all-time highs and the Fed cuts, that tends to be pretty good. So I do think we're kind of in the late or second half of a bull market. I think we have a couple years left, and I'll show you that in a second. Doesn't mean we won't see corrections. Doesn't mean we won't see a 5% or a 10% here. We very well could see a correction between now and the election, or right after the election. I mean, those things happen. But I think bigger picture over the next 2 to 3 years, I think we're halfway through this process of a bull market. The economy tends to be on pretty firm ground. I'd love to see inflation continue to come down, but it's likely the Fed's going to raise rates. So I think those are things we're looking at going forward. So then the other thing is the election coming up, right? So we have an election. I picked this off of Polymarkets this morning. I know there's a lot of different polling sites out there. Some lean Democrat, some lean Republican, some are better than others. Some poll more people, some poll less people, margins of error, all that stuff. I tend to look at the betting markets. John and I were having this conversation before the thing, and it's crude, but I'll say, the old saying, money talks and bullshit walks, so to speak. So over $1 billion has been betted on these sites, specifically on Polymarket, which tends to be the biggest. I don't even know if Americans can even vote on this, or I'm not sure how the process works. But right now, the betting is leaning towards President Trump. Again, we got 3 weeks to go. If you looked at this 2 weeks ago, it's looking the other way. So these things can change. Not saying it's a done deal by any means. I do know that Real Clear Politics, which is another site that aggregates polling data, I think has President Trump winning the blue belt or Rust Belt states, which puts him in a pretty good stance. But again, we got a long way to go, and a lot can happen. So anyway, um, but what does this all mean? And I know I get this a lot. Well, I'm worried about Trump winning, or we're about Harris winning, and she's going to raise taxes, he's going to raise tariffs, and the world's all coming to an end. And as I said earlier, it really likely doesn't matter who's in the White House in the big scheme of things. Obviously, I think there's a likelihood we'll see divided government anyway, as far as the Senate goes versus the House. So as you can see, there's what 6 different variations here. Um, you're some are a little better than others, but historically speaking, it doesn't really have that big of an effect. I think we're going to see most likely see a Republican Senate. There's a probably small chance we can see a sweep by the Republicans. Unlikely. It's very likely we could see the Democratic president and a Republican Senate, and so that'll add some gridlock to it. If there's one thing I think we're looking at going into next year, or the outcome to this, one of them would be the 2017 tax cuts all expire next year in 2025. So there's going to be some horse trading going on to try to figure out how to get a compromise bill passed, especially if we have a divided government. So I think that's something that we're concerned about, and I think will play out next year, and could add some volatility to the markets as well. As I mentioned, we're about halfway through the bull market. We just hit the 2-year anniversary, so that's 24 months. This chart's a little dated, but that's 24 months. As you can see, the average is about 5 years, or 61 months. So we're more or less just short of the halfway mark. Then that's the average. Doesn't have to go 5 years. It could be 4. It could be 6. It could be 7. So we'll see. But history will tell you we have a little bit more to go. So I hope it's right. So I'm going to stop there, John. I can take any questions if there are any left. If you have any comments, that's fine too. But
yeah, just one more question from our clients, and it goes back to the utility discussion where you brought up those points earlier. What about utility infrastructure versus the pure play utility companies? So what about the actual just the infrastructure opportunities there versus a pure utility?
yeah, I don't know that area well enough that there's public companies out there. I know there's a lot of private equity or private market opportunities in infrastructure. We have one that we partner with KKR that has a infrastructure fund. If they're interested in that, they can talk to their advisor, and we can get them some information on that and kind of go through it. But yeah, I mean, I think there's going to be opportunities out there. There's areas of the market or areas of the economy that are going to benefit from what I think is an expansion of the electrical grid, or electrical power, however you want to say it. Is that one of them? It very well could be. I don't know the space as well. I don't think there's a lot of publicly traded companies on that end. Those things are probably more on the private side, but we do have some vehicles that could help you get access to that if that's something you're interested in.
Okay. One more. Do the markets favor gridlock or divided government? I'm thinking divided government is the same as gridlock, but
Yeah, so I think that does it favor a split? I think it does. I think history would tell you that the returns again are probably pretty similar, but I think it does tend to favor that. I think where it favors it is, you have to make compromises. So again, I was talking about the 2017 tax cuts. I know Vice President Harris talked about raising corporate taxes, and one of the interviewers asked, well, how are you going to get that passed? Because if it's a Republican Senate, they're not going to just roll over on that. If it's a Republican Senate, if she gets all, if it's a blue sweep or a Democratic sweep, well, that's different. But I think divided government tends to be more beneficial because, to be honest, not much gets done. And I think the best outcome would be something of that nature. Like I said, a little less than 3 weeks to go. So who knows how this will swing at the end. It's probably going to be one of the, or at least as of today, it looks like one of the closest ones we're going to have. My hope is we don't get to that point where we can't figure it out and it takes 2 weeks and they're filing lawsuits and the courts get involved. That would be I know you asked, I don't know if you asked this time or what we were talking about the wall of worry. That would be a wall of worry. That'd be a pretty big brick in the wall of worry. Hopefully that won't happen, but
Thank you.
yeah. Well, hey, listen, I appreciate it. I don't know. I know you have some closing remarks there, John, but
Yeah,
appreciate
I
everybody
just want
calling
to
in.
thank, I just want to thank everybody and thank you, John. And if we were unable to get to any questions, the investment team, or if you have any that pop up later, the investment team and or your advisor will certainly reach out to you directly to get those answered for you. So thanks again for joining us today. It's really our privilege to work with you and your families. And we really do feel a sincere gratitude for your trust and loyalty in Fairport. So have a great weekend. I hope, and I know there's this big high settling over, I think, a lot of the country. So I hope you're enjoying the sunshine that we are here as well in Pennsylvania. And have a great weekend. Thank you, everybody.
Thank you.